Are you seeing the screen, boss?
This meeting is being recorded.
Are you getting the screen?
Sir, what today one session? Today one session and Friday one session. That will be okay, right?
Okay, no problem. Okay. Friday, I think we can focus on international banking. So today, I think only finer aspects of risk management. For example, all of you are seeing the screen, boss.
Sir, if we are since
one
we are
point you remember.
Since we are covered international banking, I think let's see if Murugesan, let's see the schedule of Murugesan sir, which Sri Krishna sir we have given for Friday. Let's see then I shall update you, sir.
Okay. You update me. Friends, maximum credit risk cover from CGTSME now up to 150 lakhs. That is 75% of 200 lakhs. This is one of the new question. Remember. Agreed. Question answer. Now CGT is giving, you see the answer. What is okay, I will load it. Load the pointer also. Yes, maximum credit risk cover by CGTSME now 70% of the loan amount subject to a maximum of 150 lakhs per borrower. That's the answer. Okay. Question answer. Okay. Now question number 2 quickly. Interest rate mismatch risk mean liabilities fixed, assets floating. That will become a
previous question. Your answer is E.
Answer is E. Oh, sorry. Oh, I have corrected. Wow, it is not corrected. Okay. The answer is B, pass. Okay, right now I will correct. Otherwise, okay, it will be B. Okay, by mistake, typing error. Okay. Why this button is not working? Oh my God. Working. Pointer. Okay. So the correct answer is I have corrected, but how it was missed. Okay. So subject to B is the answer. Interest rate mismatch risk mean all of you remember there is a mismatch between floating and fixed. Assets will be either fixed rate, floating, that is interest rate mismatch risk. We have something which we have already discussed. I will just brush up your memory. Counterparty risk mean in a contract there are two parties. The other party doesn't deliver as per the contract. It is called as counterparty risk, especially used in derivative transaction. Now, the definition of risk, minimum 2 questions they are asking. Every year, definition of risk is funding risk, time risk, Kershaw risk, counterparty risk, sovereign risk. So many, some 2 questions, definitely they are asking about definition of risk because risk management is such a vast subject. Okay, understood, boss? So I will, it's okay for you. Now quickly answer. Counterparty risk mean the risk on account of the other party in a contract. Agreed? Okay. Yes. Then concentration risk, excessive lending to a particular group. I think all of you will agree. Agreed? Concentration risk means
Yes, sir.
I will share with all of you. I think I am yet to share with you because risk management mostly our sir will have shared with some of you. And I have got 5 modules. All the 5 module I will share with all of you. You just have a glance. You are comfortable in risk management. Don't worry at all. Theory as well as practical. I will, after discussion, I will. Okay. So question number 6, 4. Concentration risk, all of you are familiar. Agreed. Whichever you know, I will not focus on that. So answer is excessive lending to a particular group of borrowers or a particular industry. It is called as what? Concentration risk. What is sovereign risk? I think all of you know the default on the part of the government. The default on the part of the government. Correct, boss? Are you all with me? Yes or no? Tell
Yes,
me.
sir.
Yes. Just a brushing of memory, boss. Nothing you are new. Only you are remembering the points. Okay. Now, Kershaw risk. This is a new thing. You have to remember. Kershaw risk. What is Kershaw risk? Yes, cross currency settlement risk in cross currency transaction between 2 countries. Okay, very good. Okay, funding risk. Funding risk means either you will not be able to fund for fresh loans or suddenly unexpected withdrawals are taking place from deposit. So you are stuck up with no funds. So that is called as funding risk.
Sir,
Okay.
excuse me, one
Situation.
doubt, sir. Sir, any difference
Tell me,
between
boss.
funding risk and embedded risk?
No, embedded risk is different. Funding risk means you have to take care of both the aspects. Funding risk means you have to fund the creation of new loans also, and you have to fund the expected withdrawal also. But embedded risk means in deposit to loss, embedded risk in a loan also, the borrowers have the right to pre-close a deposit or prepay a loan. That is called as embedded risk. Okay. This risk is from bank's point of view. Embedded risk is also bank point of view, but the customer will exercise from their side. Funding risk is always from bank side. But embedded risk is what? Customer may exercise their rights to pre-close a deposit or prepay a loan. Agreed, boss? Understood? Small difference.
Okay, sir.
Yes, you are correct. Embedded risk is different. Funding risk is different. Time risk is, you remember very clearly, contingent liabilities. The LC guarantee may land on the, it may crystallize. So time risk mean easily can remember. This I will share with you. Just have a quick glance, you are through. Don't worry. Because I am covering almost all possible. Not a chance. Even haircut also I am covering. Don't worry. Haircut, standard haircut, all this I am covering. Don't worry. Call risk mean, the time risk is different. Sorry. Time risk mean, call risk is contingent liability. But time risk mean suddenly unexpected, yes, NPA. The time risk mean, okay, the bullet is not coming. Okay. Time risk mean suddenly account becoming NPA before the due date. Quick mortality account. The time factor. It has become an NPA more than expected. So that becomes a time risk. Call risk mean contingent liability. Call risk mean all LC guarantee, crystallizing, that becomes a call risk. It's a peculiar name. Basel 3 has given, we have to remember, no other way. What's the logic? Don't worry. Call risk means this is the risk. Okay, basis risk. So many questions they will ask. Basis risk means you are linked to different basis rates, reference rates. That is called as basis risk. Sometimes you are linked to MIBOR, sometimes you are linked to RLLR, sometimes you are linking to MCLR. So that is called basis risk. The interest rate getting linked to assets and liabilities, linked to different benchmark rate is called as basis risk. Okay. Yield curve risk. This is unparalleled movements because sometimes assets will increase by 50 points, housing loan 50 points, but deposit will offer only 25 points. So the mismatch between pricing of assets and liabilities sometimes will create what? Yield curve risk. Yield curve means there will be upside movement, unparalleled movements from, because uniformly you are not increasing or decreasing for assets and liabilities. That is called as what? Yield curve risk. Okay, friends? I think this we have already discussed. Anyhow, it's a quick remember, just remembering. Okay. Now, if maturing assets in a time bucket more than maturing liabilities, it becomes which risk? They will ask. It becomes not an interest rate risk, it is not a maturity risk, it is called as what? Gap risk. There is a gap. Gap between, in the same bucket, there is a gap in outflows and inflows. Maturing liabilities are always outflows. Maturing assets are inflows. Positive gap, negative gap, it will arise. Okay, friends? Okay. So it is becoming a gap risk. Again, gap risk, there is a positive gap, negative gap. I think this is a balance sheet management we have discussed. Okay, but this is a gap risk. So sometimes it's very difficult to risk on account of recession, wars. What is the risk? Systematic risk. Now, because of Corona, there is a downward trend in the economy. All banking sector, every sector is affected. So this is called systematic risk. Systemic risk is different. Systematic risk. What is systemic risk? Systemic risk. For example, banking, lot of frauds suddenly started appearing because of some deficiencies in our working. So this is called as what? Not systematic risk, systemic risk. Systemic risk. Small difference is there. You have to remember all this, what to do. Okay, this is definition of Basel III. Sometimes you will have, yes, some segment, for example, real estate, share market. You know very well, this is a segment where there is an inherent risk. Okay, so that is called as intrinsic risk. That is called as what? Intrinsic risk. So these are the definition given by Basel III. One or two questions will come, just to keep a watch. Okay, friends? And number of credit weights, this question they have asked. Basel 1, how many risk weights were there? 5 risk weights were there. Under Basel 1, and Basel 1 addressed only credit risk. Remember, Basel 2 included 3 risks: credit risk, operational risk, and market risk. But Basel 1 took care of only credit risk. And 5 risk weights were assigned. What are the 5 risks? 0, 10. Okay. This. Okay. Okay, friends. Understood? Question answer. Which is not the 3 pillars of Basel 3, Basel 2. Always they are asking 3 pillar. Okay. 3 pillar, you know, capital adequacy, supervisory discipline, market discipline. These are the 3 pillars of. Okay. This I think is only pressing memory. Understood, friends? 18. Okay. Which of these not advocated mother for credit risk management? Credit risk management, there are 3 approaches. First approach is standardized approach. Second is FIRB approach. Third is AIRB approach. So most of the banks are still in standardized approach. Okay. And this is not the approach. Basis indicator approach is applicable for operational risk. So they will try to confuse you. Basel 3, when it is implemented. Any idea, Bas?
2013. 2013 April 1st.
The question you read carefully, as on. As on mean you have to use the word 31.3. Oh, what happened? I think now. Screen now is not moving something. As on means 31.3 Bas. Effective from 1.4. As on mean which day? Correct answer is 31.3. Correct? Okay. 31.3 2019. So simple question. LCR. What is LCR? It is for the purpose of the crisis period, critical period 1 to 28 days. Okay. LCR is prescribed. Now as per Basel 3, liquidity coverage ratio. Okay. That critical days is stress period. That is called stress period. Some books they are using 28 days, some books they are using 1 month, 30 days. Okay. So whichever is there, normally 28 days when they will not use the 30 days. But they use the first 30 days in, you click that word. 30 days, some books they are using 28 days. Okay, sometimes RBI circular also, you know, slight difference will be there. So 28 days, that first 28 days you have to be careful, or first 30 days. Okay, that is LT. Hybrid debt means, hybrid debt always qualifies tier 2. Hybrid means what? Combination of equity and debt. Okay, hybrid debts always qualifies what? It will never be tier 1, it is tier 2 only. Okay, so market risk will be managed under normally SD approach, standardized duration approach, or internal models approach. Okay, now most of the banks are in. Okay, I think screen is moving fast. Operation risk, there are 3 measures, 3 approaches. BA approach, standardized approach, AMA approach for operation risk. Okay, question answer. And RW for corporate borrowers. Triple A mean 20. Triple A mean 20. Okay, correct. WA mean 30. Okay, this for corporate borrowers, not for others. Okay, standard. A mean 50. Standard risk weight. Standard risk weight for A. BB mean 100. BB mean 100. Quick revision. That's all. Okay, friends. So is it help you? Tell me, boss. Is a
Yes,
quick
sir.
revision. Ah, yes, yes. Now
Yes, sir.
28.
Yes, sir.
BB mean 150. BB mean 150. Remember,
125.
triple B only 100. Less than triple B, double B, B, all 150.
150.
And uh,
150, sir.
B and double B, 150, 150. Very good. And guaranteed by central government, 0. Guaranteed
0.
by central government, 0. But guaranteed by state government, unrated borrowers, 100. Unrated borrowers, 100. Is not rated, 100. You see, these things you have to remember. And these are the schedule I will share with you. Okay, 20 is a ready schedule. Okay, friends. Okay.
Sir,
Now,
for credit card 125. Is it correct?
yes, coming. In another slide, I am now housing loan also. Now commercial real estate. Okay. Oh, I think. Oh, the screen is running. The commercial real estate 100% risk weight. The commercial real estate is different. Commercial housing is different. Then suppose in a big complex, there will be commercial mall also and residential property also is there. That is called as commercial housing, residential housing. Risk weight is 75%. And fully real estate, commercial establishment. Now earlier they were offering 150%. Now RBS to encourage such activity, 100% risk weight. And housing loan, now I have corrected elsewhere, but I have not corrected here. Now up to 30, 80 all gone. Now only 2 slabs. You can note down. Only 2 slabs for housing loan. The LTV is 80 or less than that, 35%. Note down. I will share with you in another. I think I have updated in another schedule. This I have not updated. Now the loan to value, but they will give indirectly. How they will give, you know? For example, a flat is costing 1 crore. A flat is costing 1 crore, including indirectly they will give. Question how they will give? A flat is costing 1 crore, including, and they will give stamp duty and registration also you can load. So including stamp duty and registration, 1 crore, 100 lakhs. A bank is giving 85 lakhs loan. What is the risk weight assigned? They will ask. Now, when the bank is giving 85 lakhs, LTV is exceeding 80%. Now, there are only 2 slabs. If the LTV is not exceeding loan to value, LTV means loan to value, not exceeding 80%, 35% risk weight, exceeding 80%, but within 90, because no bank should give LTV beyond 90. At least margin should be 10%. Housing loan. Okay, if you give that, now 50% risk. Only 2 slabs. Okay, earlier amount was there. You remember, questions will be, I will give questions. And consumer credit, 100, 100. Credit card, 125. That chart I think I updated elsewhere. I am sharing with you 5 levels. All quick questions. If you read it, I am comfortable, you will crack. Risk management, very fantastically. All question, yes, I am covering. Okay. Consumer credit 100 bus and NBFC 125, IPO finance 125 risk weight. Note down, credit card receivable 125. Consumer finance 100, but credit card receivables 125% risk weight. Staff loan, there are 2 categories. Staff housing loan supported by terminal benefits, backed by terminal benefits, 20% risk weight. All other staff loan, 75%. Okay, this is the chart I will update the chart. And NP accounts, there are 3 risk weights. They will ask, how many risk weights are there for NP accounts? You have to tell only 3 risk weights. First is what? The provision. Okay. Oh, sorry. I think something is there. The provision available is less than 20%, 150% risk weight. The provision, total provision available is more than 20%, but less than 50%. Risk weight assigned is 100%. But if the provisions available are 50% or above the outstanding liability, now the risk weight assigned is 50%. Based on that, indirectly they will give question, just wait. Okay, the 3 slabs you understood. NPA mean only 3 slabs. Risk weight 3 slabs. 100%, 150%, 50%. Where you 50%, you have an idea, questions will be asked. Definitely questions are asked. Now Basel III introduced dash to manage short-term liquidity, LCR. Short-term liquidity mean LCR. Okay, not counter-cyclical buffer, NSFR, net stable funding ratio. That is all for long term. Short term in only LCR. Okay, LTV fixed is higher when the risk is lower. LTV mean what? You are giving more loan and you are reducing the margin, the borrower is good. So the LTV fixed will be, oh my God, what happened? LTV fixed is, I think the screen some, screen is dancing. Why? Okay. The button is not coming. Okay. LTV fixed is higher. 4 options they will give because you are giving more loan and you are reducing your margin for whom when the risk is less. When the risk for a borrower is yes, you are reducing the margin. So the LTV fixed will be higher. The answer is B. There are 2 blanks. Intelligently, you have to pick up the correct answer. Okay, understood? So this question, I think you can easily understand. 33. According to Altman set score. What is Altman set score, boss? To find out bankruptcy of a company within the next 2 years, he advocated a formula. If the set score, if the score is less than 1.81, the company will definitely become what? Bankrupt. But if the score is more than 2.99, that is 3, definitely the company is sound, financially sound. It will not become a bad account or insolvent company. Okay, that was invented by Altman. I think 1 year 5 questions were there in Altman. It's a old concept. No banker is following. But for exam angle, they will simply, yes, ask questions on Altman set score. Okay, understood? I'm sharing some question. And it is based on 5 parameters. Altman set score, how many parameters they will ask? 5 parameters. What are the parameters? Profitability, liquidity, solvency, leverage, and activity. Yes, boss. Yes,
Sir,
wherever
what
you
is the leverage
have,
means, sir, in banking parlance?
leverage means less of capital, more of other funds. That is called leveraging. What is leveraging? You know, you are putting 10% capital, 10 rupees as capital, 90 rupees you are borrowing from others, and you are doing 100 rupees business. This is called as leveraging. What is leveraging? You are doing more business, high levered company. You are depending on others' funds. You are putting your funds less and you are depending on other funds. This activity is called as, in financial parlance, leveraging. High leveraging companies are always risky. High
Okay.
levered is high risk, high gear or low gear. They will ask. High levered companies, leverage is high mean high risk company. That is
Okay.
What they are taking more loans. That's the meaning. Okay, friends. The
Okay,
forward contract will manage only exchange rate risk, because this question also they will ask. Risk management mean what is the risk management product? To manage exchange rate risk, which product will be used? So forward contract will be managing exchange rate risk for a period maximum 1 year. Okay, they will give option, pick up the correct answer. And currency option, again it will manage exchange rate risk again up to 1 year only. Again up to 1 year only. Okay, these are all hedging product. And capital needed by banks, one example I have given, there are 3 banks with 3 different assets. Yeah, all banks are having 1,000 crores assets. This bank 500 crores in 20% risk. Okay, 500 crores in 20% risk. This is 300 crores in 50%, 200 crores in 100. This bank 400 crores in like that, like that. Now you have to find out which bank is strongest, which bank is weakest, which bank needs how much capital. 5 mark question will come. Okay, how to calculate? Easy. Okay, for example, bank A. Bank A, how much you have to calculate, you know? Bank A answer is, okay, oh sorry, why the screen is moving? Okay, now 50 into 20. I think the point is not coming. The bullet point, correct, now it is coming. Okay, laser, right. Now 500 crore, 20%. So 500 into 20, 100. Okay. I think this is needed for which bank? Okay, the earlier one. Bank 1. Bank A, 500 into 20, 100. 300 into 50, 150. 200 into 100, again risk weight is 200. Okay, so total risk weight is 100 plus 150. Each bank, we are, okay, the steps are there. How to calculate the total risk weight, how to calculate the capital. This question they will ask, 5 mark question, or it may be a case study. Find out which bank is best, which bank is worst. So you have to calculate like this, because so bank, for example, bank A needs 40.5 crores capital. Bank B needs 36 crores capital.
Sir,
Get
what is that
different,
9%, sir?
9 is the standard numbers. For capital
CRA.
adequacy, CRAR normally 11.5 including CCB, but for calculation purpose, capital needed. This question, minimum 5-10 questions will be on what is the capital needed for this exposure, capital charge. For calculating capital charge in arithmetic, you have to use 9%. Okay, because Basel III is recommending 8%, but in RBI in India, they want all the banks to minimum the core capital, excluding CCB. I think all of you know what is CCB, capital conservation buffer, that is
Observation.
2.5. Yes, so bank has to maintain 9% on risk-weighted assets. So here, bank B needs only 36 crores. Now bank C needs 45.90 crores. Now tell me which bank is good, which bank is bad. Whichever bank needing less capital,
Yes, capital.
yes, is the strongest bank. Whichever bank needing more capital because they are having more risk-weighted asset, that bank is the weakest bank. So like that, 5 mark question will come. You can beautifully answer. Understood? Okay. Now, so I have explained also. Okay. Now haircut. The haircut is nothing but, don't get confused. They will not give complicated question. Simple, straight question only, haircut. Haircut for, what is haircut? Remember, potential loss, possible loss when you sell a security charged to a bank. Bank is taking so many securities. Gold you are taking, fixed deposit you are taking, NS you are taking. Now shares and all, shares and okay, EMT not recognized as eligible collateral under Basel III. Remember, shares, if you have taken shares from credit angle is okay, but Basel III does not recognize shares as a credit risk mitigant. The word is CRM, credit risk mitigants. To reduce the credit risk, you are taking collateral. All other securities, all other collateral, okay. Deposits, okay, zero haircut. LIC, zero haircut. LIC surrender value, zero haircut. What is your haircut? You may lose by selling the security. Okay. NSC, zero haircut. But for gold, 15%. Remember, for gold, 15%. For example, you see the question, one branch has given 100 lakhs. Okay. Bank has given 100 lakhs and FD 30 lakhs. There is no mismatch in maturity. Both are, this also loan is 3 years, fixed deposit also mature in 3 years. So you can straight away apply the formula. What is the haircut adjusted? FD 3 crores, 30 lakhs, no no haircut, zero haircut. So 100 minus 30. 100 minus 30, how much? 70. Now what is the risk weight assigned for this category? 75%. Now the risk adjusted, haircut adjusted exposure means 70. And what is the capital needed? Capital needed, again you have to apply the risk weight applicable for this category. Now he is getting only 100 lakhs. Now this comes under retail regulatory exposure. Note down, retail regulatory exposure, risk weight is 75%. Some standard risk weight you have to remember always. House, staff loan, staff housing loan 20%. Other staff loan 75%. Are you not remembering? Similar way, if you remember the risk weight, it will help you in arithmetics. Okay, friends. Now, this is the 100 straight away 30 you minus. Suppose the haircut is 10% mean 30 lakhs minus 10%. So 3 lakhs will be losing. So 27 crores only you can reduce. For example, I am telling. Suppose the gold 30 lakhs mean 15% you have to minus, then only the real value will be down by 15%. Agreed, boss? How to calculate? I think we are, yes, we'll go one by one. Now this question understood? Yes. Now this is level 1. Okay, quick revision. Now shall I go to level 2? Don't worry. All possible questions I am giving you. Level 2. Okay. Now again I have to share. Okay. Otherwise, sometimes, yes, the meeting is recorded. Okay. Yes. Are you getting the screen, boss? Are you all getting the screen? Yes or no?
Yes, sir.
Okay. Now level 2, quick questions. Now you note down RW for NP accounts where the provisions available are less than 20. Straight away you tell me 150%. Answer is 150%. And they will give an immediate question. Indirectly they will give. Bharat Bank has got, okay, again I will load my, okay. The pointer again, pointer, luckily. Okay. Now Bharat Bank has got 1,200 crores NPA, where the provisions available are 200. So 1,200 less than 20. 1,200 20% how much was 240. But the provisions available, total provisions available is 200 crores. Indirectly they are telling it is a less than 20% provision. So it will comes under risk weight 150. So 1,200 provision available are 200. Indirectly is a question. So you have to charge how much? 150% risk. So 1,200 into 150 means 1,800. How much capital is needed? 1,809, 160 crores. Is a one mark question. Believe it or not, these questions are frequently being asked. NPA. There are 3 levels of NPA, 3 levels of risk weight. By heart, now you understood? Provision less than, okay. Now next question. Provisions available more than 20 but less than 50. Now, what is the risk weight, boss? All of you tell. What is the risk weight? Risk weight is 100%. So they will give a live example. Bharat Bank has got 200 crores NPA. Which is the category? Don't worry. Simple NPA, but the provisions available is 500 crore. 2,500 crores constitute how much? 2,500 crore means 25%. So it is more than 25, but less than 50. Now what is the risk weight assigned? Tell me, boss. What is the risk weight assigned? Tell me.
100%.
100. So what you have to do? 2,000 into 100, 2,000. Step by step. 2,000 into 100, 2,000. How much capital is needed? 2,000 into 9, 180 crores. So 180 crores needed for this exposure alone. These are the questions they will ask. Numeric question. Now question number, yes. Okay, NPA. NPA for NPA 3 levels. Okay, where provisions available are 50 and above, you have to give risk weight only 50%. Example, Bharat Bank has got 2,000 crores NPA, but the provisions available are 1,100. What does it mean, boss? What does it mean?
More than 50%.
Provisions are more than 50. So how much risk weight? 50.
50%.
So 2,000 crore, 50 only you put 1,000. 2,000 crore loan, NPA, but 50% risk weight, 1,000 crores. Capital needed will be 90 crores. That's all. But if you miss one concept, you will land in a wrong answer. Question, answer, question, answer. Tuck. You are through. Don't worry. Okay, now 7th question. Yeah, guaranteed by central government, zero risk. No problem, zero risk. And state government, 20% risk. That is the thing. Central government only zero risk, but loans guaranteed by state government, Basel III recommends 20% risk weight. Then calculate the, okay. For example, Bharat Bank granted 400 crores to a company and is guaranteed by state government. How much capital needed for this exposure? This is the question they will ask. So 400 crore state government mean 20% risk. So 80 crores. So the risk weight is 20% mean 400, 20%, 80 crore. 80 into 9%, 7.2 crores capital is needed. Agreed, Abbas?
Yes, sir.
Yes or no?
Yes, sir.
Yes. This will help you.
Yes.
I am telling you what we discussed in the last minutes. So many people have been benefited and they are through. Okay. Now question number 10. Question answer. I think 10 is missing. Basel III prescribed CET. CET means common equity tier.
Common tier 1.
Yes. How much? Tier 1. How much? 5.5. Additional tier 1, 1.5. So 5.5 plus 1.5, 7. And tier 2, tier 1, Basel III prescribed tier 1 as minimum percentage of total RWA. How much? 7%. 7 is the answer. Total tier 1. And the tier 1 consists of now core capital plus additional tier 1. Additional tier 1, how we are creating? By retaining the profits. By retaining the profits, and you are not supposed to declare dividend also. Whatever profits, if the capital is very low, you have to, that also we'll discuss. That is known as what? Capital conservation ratio, CCR. Okay. Whatever profits you are earning, if your capital is very low under tier 1 category, you have to retain the profits and you have to add to the capital. You are not permitted to declare dividend. There are 4 slabs we will discuss. Okay, friends. So all this I am sharing with you. 12th one, 13th one, minimum, yes, conservation buffer is percentage RWA 2.5.
2.
Yes, 2.5. Quick answer. Now, CRAR excluding CCB, including CCB should be 11.5. Correct. Simple question also they are asking. Okay. 15. Minimum tier 2, how much? It should be 2%. Minimum tier 2. But maximum cannot exceed tier 1. Tier 1 is 1000 crores mean tier 2 cannot be 1100 crores. It cannot exceed, but minimum is 2% of the risk-weighted assets. Tier 2 should be minimum, tier 2 should be 2% of the risk-weighted, total risk-weighted assets. Total mean credit risk, market risk, plus operational risk. All will be added. And what is the risk parameter? Credit risk 65% was. Credit risk 65%. Sorry, 60, I think. 60. 60% of the bank loss is contributed by credit risk. 25% of the bank loss is contributed by market risk. 15% is contributed by operation risk. This is a thumb rule. Sometimes they will ask that question also. How much credit risk percentage in a bank loss? Approximately 60%. Operational risk, how much percentage? 15%. Market risk contributes how much for the bank loss? 25%. You total it, you are getting 100. 60, 25, 15. Agreed, boss? This is the Basel approach. What is CCD? You have to take care of the bad times ahead. You are right now, you are building a buffer capital. Capital conservation buffer. I think all of you know the buffer means something to take care of a future contingency. So 2.5 for a future, if you have some issues, banking may not be same as today. So challenging days are ahead. So like that. Now, for example, they will give like this. One live example is a AAA rated borrower. You have given loan of 10 crores. What the risk weight and what is the capital charge thereof? They will give 4 options. So immediately you can calculate. AAA mean you have to remember 20% risk. So 10 crore will become 2 crores. The answer is given here. AAA mean you have to remember 20%. So 10 crore loan will become 2 crores only. This is a risk weight. So capital needed is 2 crore, 9%, 18 lakhs. That's all. Okay, you have to pick up the answer, 1 mark. Simple question only they will ask. Next question, for example. Next question. It's a double B rated borrower. You have given 10 crore loan. What is the risk weight and what is the capital charge? So the risk weight is rated BB. BB means 150%. So 10 crore will become 15 crore. 15 crore 9% is 135. So the answer is B. Okay, boss? Understood or not?
Yes, sir.
Am I going fast or am I going just yes, refreshing your memory? That's all.
Moderate only, sir. No problem.
Correct. Okay. Okay. Now next question. This is a different question. Remember, different question. Loan to Mr. A, 8 lakhs. Secured by NSC, 1 lakh. LIC policy, surrender value 20,000. What is the risk-weighted assets after affecting applicable haircut? Okay. Now first rule is deduct the eligible securities. Here no haircut. 1 lakh and 20,000, no haircut. So minus that 1.20. 8 lakh loan you have given. Eligible collateral you have to minus. I think one terminal background noise. 6.80 lakhs is the haircut adjusted exposure. Okay. Loan, this is a step by step you have to understand. First you minus the securities after affecting haircut. Okay. Now, what is the 75%? Because a retail borrower. Retail regulatory exposure, risk weight is 75%. Another, note down, the standard thing you have to remember. I gave, unrated borrower 100%, AAA rated 20, AA 30, A 50. These things you have to remember. Gold mean 15% haircut. NSE mean zero haircut. LIC mean again CCF. I think all of you know CCF, credit conversion factor. What is the credit conversion factor? For LC, collateralized LC, only 20% is the CCF. For bid bond guarantee, 50%. For performance guarantee, 50%. CCF. CCF means credit conversion factor. Okay. These things are repeatedly asked. Supposing there is a CC limit. Okay. This is all coming step by step. I am not, yes, excluding any question. Yes. So 8, 1.20, you are minus 6.8. Again, you are multiplying with risk weight, 75. So 510. On 510, again, you can calculate capital. 510 is the risk weight. So capital is 510 into 9%. So it will be thousands only. Okay. So here the question is, what is the risk weight?
Sir, why we have to take,
Yes, boss.
why we have to take as a retail customer 75%, sir? Is there any
Yes,
in,
note down. All individual borrowers other than rated borrowers up to 7.5 crores. Limit is 7.5 crore. The credit card also retail borrowing, but that are all classified items. Specific weightage mean, risk weight mean, you have to take that into account. But
But you are
if
having
not
that separate
specified,
PDF, no sir. You told you will send that 5 PDFs, no sir. Sir, you informed that you will send that 5 PPTs, no sir. That is there in that PPT, yeah?
Yes. All PPT. I think have I sent to all the PPTs? I will send.
No sir, we have
Risk
not.
management. Just have a look at it. No problem. All are covered. Step by step, I have covered. Okay. I think one terminal, they have to mute. Otherwise, background noise. Okay. Now question number 20. Quick question answer. He got a question. So retail, how will know? If the limits are for SME units, for partnership or individual, up to 7.5 crore, please mute. Up to 7.5 crores is considered as retail regulatory exposure under Basel III. Risk weight assigned is uniformly 75%. That is why staff loan is also staff loan other than housing loan 75%. Okay, uniformly up to 7.5 crores. Remember, earlier it was 5 crore. Now retail regulatory exposure up to 7.5 crore. Risk weight is uniform 75. Other than specific categories. Specific categories means what? Consumer finance, 100% risk, not 75. Credit card receivables, 125%. Venture capital, venture finance, 150%. Venture finance, IPO finance, 125%. These things you have to remember, boss. No other go. It will help you to do. Okay, for example, party has got LC liability. One small borrower. He is not a company. 50 lakhs LC liability. He has offered a security, fixed deposit 5 lakhs as collateral. Okay. What is the risk weight? So the risk weight is, okay, is a LC liability 50. So the step is you have to apply credit conversion factor. Because LC is a non-funded. It will not immediately become a funded. So for LC, the CCF is 20%. So the exposure is 50 lakhs. Oh, sorry. I will clear the throat because continuously I am speaking, that is why slight, otherwise no issue. Don't worry. So 50 lakhs is the loan you have given and CCF is a LC opened. So 50 lakhs, 10 lakhs will become a credit exposure. That is why credit conversion factor. And deduct cash collateral. So 10 lakhs may you deduct your.
sir, one thing,
Yes, boss.
sir, actually, for loans only, for when we have given a loan to borrower, for
Undrawn
That is different.
portions only we have to take
Yes,
this
yes,
credit conversion.
yes, yes. Not only for undrawn balance, the undrawn balance will come under two categories. CCOD, whatever undrawn balance, 20% CCF. Suppose in term loan, the term loan may be availed in the next year, 50% CCF.
Up to 3
The
year
term
or
loan
after
may
2
be
year.
after 1 year. After 1 year, whether it is 2 year or 3 year, the CCF is 50%. Current year 20%. I will give the, I
Yes, sir.
am going to share the chart with you. If the CCOD or term loan, if the expected trial, the undrawn balance, if he is wanting to draw in the current year, the CCF is 20%. But if the undrawn balance is likely to be drawn only in term loan, in CCOD, there is no question of next year because CCOD maximum validity is 1 year. So in the case of term loan, if the amount is likely to be withdrawn in the next year, the credit conversion factor is 50%. Whether it is 2 year or 3 year, term loan sometimes will be dispersed in the second year, third year. Something will be in the second year, something will be in the third year. When the
Sir,
project is complete,
whether do you have any chart regarding this credit conversion factor for all
yes,
these?
yes, I am sending a chart. In my level 4, I have
Please share
given
this,
a
sir.
chart. If you want right now, you can note down. I can give from my memory.
Okay, sir,
LC
no
is
problem, no problem.
20%. Note down.
Sir, please
I will
give chart.
forward. Okay, I will forward. Okay. Chart I have got. Then all the file I will upload it today. Just to have a quick look at, you are through. Because I have taken care to include
Okay.
all possible question risk management. Theory questions. Okay, this I am giving an idea. This one, no. You first you deduct the collateral, convert to credit, then -5, then it will become 5. On that you apply 7.5, 3.75 is the risk weight. So capital needed is again 9%. Risk weight is different, capital is different. Risk weight is calculated, and this should not be confused with provisions. Provisions are different. Risk weight and capital charge are different. When an account when you are giving a loan, bank is going to face 3 different headaches. Okay. NPA, when it becomes, you are losing your interest income, you are creating provision, and you are creating more capital to absorb the loss. So RW is a risk management question. Risk weight and capital needed is a risk management question. What is the provision needed is a balance sheet management question. Doubtful first year, what is the provision needed? Doubtful second year, what is the provision needed? Doubtful second year, covered by CGTSME, how to calculate the provision. This we are discussing balance sheet management with live examples. Supposing it's a substandard account, how much provision you have to make? Substandard, secured mean straight away 15%. Is unsecured mean straight away 25%. Yes. So these things you have to remember. Okay. Yes. Okay, boss. This question. Okay. So like that, the 70% when it will come, retail borrowers, regulatory retail exposure, other than corporates, other than classified item, specified item, 75%. Up to how much limit? 7.5 crores. So the 7.5 crore you calculate. This is the step by step. Don't miss any step. For example, okay, 21. Now you see, your borrower rated AA, loan 10 crore. What is the risk weight? What is the capital charge? This is the question they will ask. AA mean 30%. So the 10 crore will become what? 10 crore will become what? 3 crore. Though you have given 10 crore, 3 crore loan may become bad. That's the meaning. The probability of the account, 30% mean 30% of the loan may become a bad account. Probability of loss. On that, you have to charge what? 9% capital. What is the capital? Capital is also to absorb the future loss. Provisions are also meant for absorbing the over and above the provision, then capital will be adjusted. First, provisions will be used Afterwards, capital will be used for absorbing the loss. That is why tier 1 capital is known as going concern capital. I think this concept also you remember. Tier 1 capital is called as what? Sorry, going concern capital. Tier 2 is called as gone concern capital. I think this we discussed in balance sheet management questions. All questions I will share with you. Okay, friends. Now you understood how to calculate the arithmetical. Now you see another arithmetic. Is a borrower rated? Is a corporate borrower? A corporate borrower. The word is missing. A corporate borrower rated A with credit exposure 10 crore. What is the RW? What is the capital? So A mean 50%. Okay. So the step by step 10 crore loan is given, but the 5 crore may become a default. On that 5 crore, you have to again maintain 9% capital, so 45 lakhs or 0.45 crores. Pick up the correct answer, 1 mark. Okay. For example, 23. A borrower company unrated is a company but unrated. Unrated means you have to remember 100% risk weight. Okay. Triple B mean 150. Sorry, triple B mean 100. Below triple B, B 150% risk weight. So that risk weight, something you have to remember. So the credit exposure unrated mean 10 crore, 10 crore, 10 crore, 10 crore, 10 crore, 10 crore, and capital 9 mean 90 lakhs or 0.90 crores. Agreed. So these are the questions they will ask. Then 23. A borrower, you see, another question. A borrower availed a housing loan 85 lakhs for a flat. Basic cost of the flat is 80 lakhs. Indirectly, they are asking. Stamp duty and registration expenses 20 lakhs. Now, this is also eligible. So the total cost is 80 plus 20, 100 lakhs. But how much bank has given? 85 lakhs. So the LTV is 85. What is LTV? Loan to value. Loan to value of the house is now 85%. Agreed or not? Now risk weight is 50%. Risk weight is indirectly you have to calculate. Okay, risk weight is how much? The question is, yes, flat value 100, but you are given 85 lakhs. So that means LTV is 85%. So the risk weight is 50%. If the LTV is less than 80, 35%. Only two slabs in housing loan. Earlier 30 lakhs, 75 lakhs, all gone. Now risk weight for housing loan, two segments, dependent on LTV. Agreed? Is a new development. Keep it in mind. So questions will be there. Arithmetic questions. Theoretical question as well as arithmetic. Now 85 lakhs you are given. 50% is the risk weight. So 42.50 is the risk weighted assets. Now capital needed is 9%. Agreed, Abbas?
Sir, what
Are
are
you
the
able
two
to?
segments, sir, in the housing loan?
There are two slabs. LTV, not on bus. I will share with you. But still, yes, I am sending all the 5 tier presentation for a quick revision. Just to go through sufficient. Okay, because there is no time for you. So the risk management 5 I will share with you. Okay, is a new one. This I think this I have not handled for you. So this if you go through similar way, balance sheet management also 4 again I will share with you. Just to have a quick look at the points. Yes, you are through. International banking anyhow. Friday we'll have a discussion. Okay, brief. Okay. So this will help you because last minute, just to have a quick look. That's all. Now you see, now 42.50 is the risk weight. So 9% capital, this much capital is needed. Okay. Yes. Now 24. Which of is not approved rating agency? They will give Now, Dun& Bradstreet is not approved in India. It's a global rating. Okay, even Fitch India is approved, but because you see the question, RBI approved rating agency. Dun& Bradstreet is also a rating agency, but they are rating mostly global corporates. So in India, Dun& Bradstreet is not approved as a rating agency, but it is approved as a credit information services. Is approved as a not rating agency, approved as a credit information services. So the odd man out you have to find out. Odd man out. So the odd man out is DNB. Okay, boss? Okay. Now, which is a sovereign rating agency? Sovereign means country. You are going to rate a country. Who are that? Standard and Poor, Moody, Fitch Global. Dun& Bradstreet is not a global rating. Sovereign rating, they are not doing. They cannot rate a government. Only Standard and Poor, Moody, Fitch Global. Okay, so the odd man out is D. So like that they will give. Because the risk management, country risk. You have to measure the country risk. Country risk is nothing but sovereign risk. Sometimes they will call it sovereign risk because the government itself may default. Okay, 26. Which is this preferred instrument? This question we have discussed in our maybe in our revision earlier. There are three instruments they will give. 13%, 50% risk, 8% return. This 13 is rate of return. This 50 is risk of default. 8% yield rate, but 20% risk. 9.5, 30%. This similar question we have discussed. The answer is first instrument after adjusting the risk 6.5. Second instrument after adjusting the risk 8 minus 20%, 6.4. This third one 9.5 minus 30%, 6.65. Now tell me this is the best instrument because after adjusting the risk, it is giving more return. More income 6.65, and this is the least preferred because after adjusting the risk, it is giving only 6.4 net return. This net return is more here. So the answer is most preferred is third instrument, least preferred is second instrument. They will give similar questions. Agreed or not, boss? Understood or not? Quick revision. Okay. Yes, 27. Which is least preferred? Instrument 2. Because their return is only 6.4 after adjusting the return. So you don't invest in, but this is best, this is least. This is middle. Grading. Okay. Yes. Now 28. Yes. Bank A, this is a beautiful question. Remember, Bank A opened. I'm just giving we have discussed, but I think this arithmetic we have discussed earlier. Okay. But still new focus. I think this we have discussed in one session. But now quick remembrance. Bank A open documentary LC. I've added more. That is why I will share with all of you. Okay. Bank A opened LC, risk management, whatever discussed earlier, don't worry. Whatever I am sending today, all the 5 levels I am sending, just go through. So yes, I feel it will help you. Okay, yes. Bank A open document LC for 10 crore, backed by collateral security for a AAA rated corporate. What is the RW and what is the capital charge? First one, document LC, you have to apply CCF. CCF document LC, collateral is 20%. So the 10 crore, though the LC is, credit may be 2 crores. Credit exposure may be 2 crores because 20%. Now, again, is a AAA rated borrower. AAA rated means his risk is again 20%. 20% of 2 crores. First you apply CCF, then you apply credit. Risk weight applicable for the category. The applicable for the category is a AAA corporate mean 20%. So 2 crore mean 20%, 40 lakhs only. Then our capital needed is what? 40 lakhs mean 9%. 3.6 crore. Though you are opening LC for 10 crore, your capital needed is very little, 3.6, because it's a non-funded first. Again, it's a highly rated borrower. You see the steps. If you miss one step, you will get a wrong answer. Agreed, boss? Yes, boss. 29. 29 we have discussed. I am just giving you, I think this we have discussed. Tier 1. First, they have given the risk weight for market, for credit risk they have already given. Credit risk weighted assets for credit risk is 5,000 crore. But market risk and operation risk, they have not given the risk weight, they have given the capital. So 9% is 200 crore mean 100% how much? 9% is 100 crore mean you have to reverse. You have to come in the, yes. Okay. If 9% is 100 crore, what is 100%? So total risk weight you find out, you total it. So the total risk weight will be 8,333 crore. Okay. And now, yes, now they have got tier 1 capital 500, tier 2 capital 800. So the tier 2 capital cannot go beyond 500. So 500 plus 500 only, 1000 divided by 8.33. How to calculate the next question? How to calculate the CRAR? 8,333 total risk weight. 1000 is the tier 1 and tier 2 capital. Okay. Don't put 1300, you will get a wrong answer. Tier 2 has to be restricted to tier 1. Just to alert you, they will give this question. So 1000 only you take, divided by total risk weights. Risk weight mean credit risk, operation risk, market risk. All the three risks you have to, this is known as CRAR formula. It becomes 12%. 12% good or bad? Good. Okay. So the total, okay. Tier 1 capital itself is 12%. Okay. Sorry. Tier 1 and tier 2, the capital adequacy, the CRAR is 12%. It is a good ratio. 11.5 is required. So they are above the 12. Suppose they are less than 12, are they sort of Basel 3 requirement? They will ask. Basel 3 requirement is 11.5. Yes, sir. They are above 11.5. You understood the steps? Yes, one by one. Don't miss the steps. This is 30. This is the end of level 2. Okay, similar way, if you want level 3, I will load it. Don't worry. Level 3, beautiful questions. Level 3, okay. Risk management, level 3. Okay, risk. Okay, friends? Yes. Okay. Now, quick revision only. Don't worry. Again, I will share. Sometimes, it will. Now, yes, boss. 3. Quick. Yes. Part 3. Question number 1. RW for housing loan where LTV is not more than 80. Answer is yes, boss. Any answer? Risk weight for housing loan where the LTV is not more than 80. Yes. 35%. 35% is the answer. Okay. They will give a live example. Housing loan where LTV is more than 80. It is now 50%. Okay. Yes. Questions will help you. Now they will give a live example. Good Bank has got 300 crores housing loan where the LTV is more than 80%. Where the LTV is more than 80%. That means 50% risk weight. So 300 into 50%, 1,500. Okay. Though you have given 3,000 crore, the risk weight is 1,500. Now what is the capital needed? Another 9%. So 135 crore is the capital needed. 135 crore is the capital needed. Yes, question answer. Understood, boss? Whether this is helping you or not. Okay. For example, Good Bank has given 5,000 crores housing loan where the LTV not exceeding 80. What is the risk weight? What is the capital needed? Simple question. The answer is yes, 35%. So 5,000 into 35, 1,750. Though you are given 5,000 crore, because the 35% risk weight, 1,750. Now capital needed is 9%. Just to take your calculator, 9% percentage button you put, you will get what? You will get 157.5 crore, ticket 1 mark. Agreed, Abbas? So 5. Question number 5. Now, Good Bank has given 1,000 crores. All are variety. All I have included. So you need not have to worry. All possible question, including latest question, I have included. So Good Bank, 1,000 crores, granted to their staff. They will mislead you. Preferential rate, backed by mortgage, EMI mandate. What is the risk weight for this capital needed? So 100 crore mean 20% risk. Staff loan, no? So 20% mean 200 crores. And capital needed is 18 crores. That's all. Okay. Question number 6. 400 crores venture capital. You have to remember. Venture capital means 150% risk weight. Note down. Venture capital 150% risk. Credit card 125. These things you yourself can make a chart. You can remember. This will help you because whatever you learn in the last 3 days, that will definitely will come to your memory. I'm telling human memory is very short. You will not remember what you discussed in January, but you will very well remember what we are discussing right now. Okay. So the 400 crores venture capital mean risk weight is 150%. So 400 crore 150% means 600. Usme 9% capital. So 54 crore is the capital needed. Tuck. Okay. To know that theory you should know. Otherwise you cannot do arithmetic. Problems, case study, you should have a sound knowledge of, yes, the theory. Okay, 7th one. This is different. Please remember, the CGT SME mean different. Bright Bank has granted 50 lakhs to SME, backed by security 20 lakhs. CGT SME covers 75%. What is the risk weight? What is the capital needed? This is a beautiful question because they are including CGT SME. Step number 1. Okay, step number 1, SME unit comes under the 50 lakhs only. So the risk weight is 75%. First one, you keep it in background. Next one, you come to the next one. And the CGT SME, they will not settle 75 on that outstanding. First, they will recognize the security. So 50 lakhs minus 20, they will reduce. Okay. First step is outstanding 50 lakhs. This is the procedure for CGT and export ECGC. So separate steps. If there is no CGT straight away, but CGT SME will give settlement after recognizing securities. So first you minus the security. 50 minus 20, 30. On 30, you apply 75. This 75 is different. This 75 is the settlement from CGT SME. So the CGT SME may settle 30, 70%, 22.50 crores. Sorry, 22.50 lakhs, they may settle. On this, risk weight is 0. Remember, CGT SME provision is different. This is a risk weight for, because CGT SME is a government of India. They are going to give you 2250, they are going to give to the bank. So for that, there is no risk, 0 risk. But how much is remaining? 50 minus 22.5, 27.5. 27.5 is the remaining liability because this is a settlement from CGT. Have we got 2250? This is the step. If you miss one step, yes, you may land in a wrong. So 27.50. So here the total you make 50. So this 27.5, you have to risk weight is 75. Why 75? Because a SME unit. SME unit also comes under retail regulatory exposure up to 7.5 crore. So 27.75, 20 lakhs 62.50 is 0. So the total risk weight is 20.625 lakhs. 9% means 1.85 lakhs capital needed. Understood the steps, boss? 7. 8.1. Bright Bank has got credit card receivable. This question they are asking. Last time also they had asked. Private bank has got credit card receivable, EMIs, okay, dues, 620 crore. What is the RW? What is the capital needed for this alone? So 620 risk weight is 125. So 620 into 125, 775. On 775, 9%, 69.75. That's all. 3 steps. Tuck, tuck. Question number 9. Bright Bank has got personal loan and consumer credit, 1200. So immediately you have to remember risk weight is 100%. So 1200, 1200, 1200, 100 risk, 9%, 108. Tuck, tuck. Agreed, boss? No doubt? Okay. 10th question. This is different. You see the provision formula different, but risk weight formula different. You see, Bright Bank has got a exporter loan. They have given so many loans to exporter. Total loans given by the Bright Bank is 1200 crore. All these loans are guaranteed by ECGC. Now note on the thumb rule. When ECGC is guaranteeing, don't worry about, okay, each borrower, because the question for the entire bank is the question for the entire bank. 1200 crore guaranteed by ECGC. Now under Basel 3, just 50% is the risk weight. Note down. Guaranteed ECGC, the applicable risk weight for general risk weight, standard risk weight is 50%. This is the standard. So 1200 mean, yes, 600 will be the risk weight. The capital needed is 954 crores. Understood or not? Provision different, risk weight is different. Risk weight is calculated for the purpose of calculating capital needs. Because every capital is ultimately to absorb a future loss in our assets. Okay? Yes. 11th one. ABC Bank financed 500 crores in IPO. What the RW? So IPO means you should know the theory, 125% risk. So 500 into 125, again, here 625, credit exposure, risk weight, so 9%, 56.25. Yes, answer. And question number, different question. This already we have discussed, so I am skipping. Some questions sometimes will be repeated. And this is different. Bank A issued a financial guarantee. Financial guarantee was 10 crore. Backed by collateral security for a double A rated corporate. First one, you have to apply CCF. Financial guarantee CCF is 100. Okay. Standby LC also 100. This chart I am giving. Don't worry. Now we are in third mode. All random questions. Random. Question answer. Okay. CCF is 100. Yes, boss.
Sir, when it will be applied is CCF and when it is not? We are confusing, sir.
Oh, note down. For 3 things, CCF will be applied. Note down. For all contingent products, that is off balance sheet, non-funded credit. What are the non-funded credit? Mainly letter of credit and guarantee. CCF will apply. CCF will apply for non-funded credit. CCF will apply. Second category is undrawn balance. CCF will apply. Undrawn balance again arises in CCOD and term loan. All bill discounting. Any working capital loan or term loan, undrawn balance will arise. CCF will apply. The third one is takeover of loan. Takeover of loan from other bank. Conditional takeover is there. Unconditional takeover is there. Okay, I am giving a chart. Conditional takeover mean CCF is 100%. Conditional takeover mean CCF is 50%. Unconditional takeover mean you are taking over limits from another bank without putting any condition. The credit conversion factor is 50%. 100%, because it will become their loan will become your loan. And again, depending on the You may take over the entire limit because you are not putting any condition. So the CCA will apply for takeover limits also. Understood, boss? So 3 occasions you have to use
Understood, sir.
credit
Why? Because
conversion factor.
why? Because the question is silent on this one, CCF.
Okay. Now they will not give. So your financial guarantee mean you have to immediately imply CCF is applied.
Okay,
Okay.
sir.
So what is the financial guarantee? 100% CCF. Okay. I will give the chart. Don't worry. So 10 crore will become 10 crore. Again, the risk category is WA. WA mean 50%. Sorry, WA mean 30%. So 10 crore will become 3 crores. Okay. And the capital is 3 crore 9%, 27 lakhs. Tuck, tuck, tuck. Okay, boss. 14, for example, 14. Now performance guarantee. Remember, performance guarantee CCF is 50%. CCF is 50% for performance guarantee and bid bond guarantee. Both are different. You know the difference between, I think all of you are basically, you can distinguish between, they will give specifically. Bid bond guarantee is different. When participating in a tender, you have to give bid bond guarantee. Okay, when the contract is successfully, if it's a bidder, your customer, you have to give performance guarantee. For performance guarantee, CCF is 50%. For 2 guarantees, only 50%. All other guarantee, 100%. CCF. Okay, LC 20%. The standard you remember, you can do wonders. Okay, so 10 crore A mean it is a CCF is 50%. So 10 crore will become 5% credit risk, and again credit rating A. So again 50, 5 crore 50 mean, yes, 5 crore 50 mean 2.5 crore. On that 9% mean, yes, this is a capital needed. Okay, boss, 14, 15. Now it's a different. Now undrawn balance. Now I am bringing another concept. You understand the steps carefully. ABC firm enjoys CC limit 6 crores and the amount drawn is 5.2. First one is enjoying 6 crore mean, first point you have to remember, the risk weight is 75% because it is 6 crore. Is a retail regulatory exposure. Is a firm. Is not a company. So 6 crore, it comes under retail regulatory exposure risk weight. So first point. Second point, you note down, yes, the 5.2 straight away will become is a already drawn. So CCA will not apply. So the 5.2 straight away multiply 75%, it becomes 3.9 crores is a risk weight. Straight away are calculated risk weight because already drawn amount, no need to calculate CCF. Now how much is undrawn? 0.8 crores. 6 crore, 5.2, 8 crore. On that, you have to apply CCF. 80, 20% risk mean 0.16 crores. On that again, 70% you have to put. After CCF, risk weight applicable for the category. Then it will 0.12. Now add with this. So 3.9, 0.12, 4.02 is the total risk weight. Now what is the capital needed? 4.2, just plus 9%. 36.18 lakhs is the capital needed for this loan. Understood, boss? Now how simple it is? Simple or difficult, boss? You want me to share? I think same way you can just have a quick look at, and your risk management is made simple. Risk management, I think Krishna sir will again share with you. Now I am uploading right now, sending all the 5 modules. Have a quick look. You are through. Okay, friends, you are happy or unhappy? Same way I'm explaining. You see, another question. An unrated borrower is a term loan. Another, this one I will explain. Is an unrated borrower. Unrated borrower mean 100%. Sanction 20 crore limit, term loan. Amount availed 2 crore, 12 crore already availed. 5 crore is expected to be dispersed in the current year and balance in the next year. So you see the calculation, 12 crore already dispersed. So risk weight is 100, 12 crore you take. To be availed in this year, it is not yet availed. To be availed, apply CCF. So 5 crore will become CCF 1 crore, but risk weight is 100, so 1 crore, 1 crore. Next year you may avail remaining 12.5, 17, 3 crore remaining. So for these 3 crore, CCF is 50%. Okay. So 3 crore 50% 1.5. So the total risk weight is 14.5. What is the capital needed? 14.5 into 9%. Understood or not, boss? So like that. Okay, 17. The operational risk, how to calculate. I'm explaining 2 examples. Okay. Just to have a quick look, you are through. I think you can easily read. And one thing you have to remember, the basic indicator approach, if there is a loss in any year, that year itself you have to exclude for the purpose of average. So loss means this year you need not have to worry for the denominator as well as numerator. So 80 profit, 24 profit, 80 plus 24, 104 by 2, by, now don't put 3, only 2 years. This year totally ignore. So 52 crores and alpha is 15%. This is basic indicator approach, alpha factor. Alpha factor means this much profit may be a loss. That is, we are going to earn this much profit. But for earning this profit, some operational risk is there. So the operational risk weight is 15% under basic indicator approach. The 15% is called alpha factor. I think next slide I will show you. There are 8 segments of business for the bank. For each segment of business, there is a risk weight is different. Okay, corporate. Next question. So here, capital needed is for operational risk alone, 52 crores, 15% risk weight is 7.8. This is a risk weight. Then 9% capital. This much capital is needed for operation risk. Here this question, all year profit. So entire thing you add, you take the average 680. You don't have to now exclude because here there is 1 year loss. Here there is no loss. So to average 680 average, alpha factor 15%. So 102 crores risk weight. So 102 into 9%, 9.18. So you are calculating operation risk. Another operation risk under standardized approach. You see, this I am sharing with you. Bank earns 220 crores income in retail banking, 330 crores in corporate finance, commercial banking 110 crore. What the risk weight? Now this is a standardized approach. Basic indicator approach is based on gross income or profits, but this is based on the segments of business. The corporate finance and trading and sales and payment and settlement high risk 18%. What does it mean? Whatever income we earn, 18% may become a loss. 18% of the income earned under this category may become a loss under the risk of losses under operational risk. There are banks are facing 3 risks: credit risk, operation risk, market risk. Most of the questions will be from credit risk. Most of the questions will be from credit risk. That is a major risk. And market risk is taken care by corporate office. That also 1 or 2 questions. Where approach, VAR. All these models I am sharing with you. Okay. So next 2 segment 15%. 2 categories are 15. Commercial banking 15%. Agency 15%. Other 3 are 12. Okay. The 8 segment, this is no other choice, you have to memorize. Exam they will not give. Now you see question, retail banking 12. So 220 into 12 multiply. 220 income, the loss may be, risk weight is 26.4. Is only for operation risk. The 330 crore corporate finance, 18%. You have to remember, 330, 18% may become a loss. So 15.4 crores may become a loss. Agreed? Okay. Now commercial banking, they have earned an income of 110 crores. But there is a risk of 15%. These things you have to remember. Okay, so 3 or 4 they will give. So commercial banking 110, risk weight is 15%, different risk weight. Under basic integrated approach, uniformly 15. Here, depending on the business, 16.5 crore, total it 102. On that capital is 9%. How is it, boss? Okay. How to calculate CRR? Yes. Whether this is helping you or not. Just go through, all are self-explanatory. All I have explained the step by step is a self-tutoring, so you can just read, you are through. Okay, whether this will help you or not. Tell me, boss. Okay, haircut, everything I am explaining. Okay, gold mean how to calculate step by step. Eligible collateral, another theory question. Now you remember, eligible collateral equity is not a eligible collateral under Basel III. Convertible bonds not a eligible collateral under Basel III. It is a credit angle, okay. Your sanction authorities may be happy, but Basel III doesn't recognize shares, mortgages, EMT, convertible bonds as credit risk mitigants. Is a new rule. Agreed? RBI. Okay. So where concept you should know the formula. I think this we have discussed. Where is equal to rate of volatility into square root of time horizon. See the question. Per week mean 5%, per week mean, per year mean square root of 52. Per day, per month mean square root of 12. We have 12 months in a year. So understand the question. Formula is same. Go through the steps. You are thorough. So 28, 30, same way. End of level 3. In level 4, I am giving a tabulation. Level 5, only credit risk. So all the 3 updated. Okay, 1 or 2 errors will be there. That I will correct. Okay, this will give you a yes, boss. Now are you comfortable or still uncomfortable? Yes, friends. Now the time is 10:20, 10:15. Okay. Understood or not? Yes, boss. Yes, Ramesh ji. Now Shivani, Srikant.
We'll share this with them. Let them go through it, sir. That's better.
Yes, boss.